Good evening to one and all present here and welcome to today's event. The third straight hike of 75 basis point to tame decades high inflation. All of us gathered here today are concerned about whether the tense situation in the West could have an impact on our investments. And to provide clarity on this, we have with us our Chief Investment Officer, Mr. Sunil Damania, ready to display his opinion on this matter. Drop anything that you would like to get answered in the Q&A session towards the end. Over to you, Mr. Sunil.
Hey, thanks a lot, Jason, and very warm welcome all of you. Don't get, carried away by the red background that you see. It's just a prop, nothing to indicate that it's a danger sign ahead. But if you look at the arrow that has been shown of a percentage, it's going up. So I think you should get some idea about it. So I think today the event is over. And the event was Fed rate hike, number one. Number two, quantum of rate hike. And number three, the trajectory. That's what happened. And you would know that yesterday what happened to the indices. Before the Fed announced the Fed rate hike, and I'll come to that, it was in green, went down, again went up, and then came down. In other words, to attribute that market yesterday in US fell because of Fed rate hike, I think it would be a little unfair, because had that been the case, there was no reason after market to bounce back very strongly to the green. But post, as and when the press conference starts, and I would request everyone to please go through that press conference. It's available on YouTube. It's available on Fed website also. It lasts near about 45 minutes or so. You must listen to that, because that will give you a lot of insights about. And of course, I've tried to cover some of the finer points of that press conference also in my presentation. But before I begin this webinar, just a small disclaimer that this webinar is only for an education purpose. Whenever you invest in the equity market, it does carry a little higher amount of risk, and past performance should not be construed as an indicator for future returns. So let's start with what happened yesterday in the US market. Okay, this is S&P 500. What you see a dotted line here is a yesterday, that is previous close, and market open in the green. It remained open in the green. And then it fell. The moment that announcement came of the Fed rate, 75, it went down. And then it bounced back very strongly. You can look at this way. It bounced back very, very strongly, going to above 3,900. And then the conference started and it went down. Something similar happened with the NASDAQ too. And NASDAQ also closed the lowest point of the day. The point I wish to convey, and see, our job is to give you some finer aspects of the market movement, which doesn't get captured when you look at point-to-point returns. What does this indicate is that market per se did not react negative to the 75 bips rate hike. And in fact, if you remember the day before yesterday, I did mention that if there is a 75 bips rate hike, the market is not going to react negative to that. But what happened in the press conference did give an idea that things are going to be more and more painful for the US citizens and the US corporates. And that really spoke the sentiments on the US market. So before I come and see what impact it will have on the Indian market and how do you as an investor should play out, and also what kind of impact it could have in the rupee, because today rupee did depreciate significantly. We went below 80 rupees and we closed that. So let's try to understand what happened at the Fed meet. Third consecutive hike of 75 bips rate. I again repeat, third consecutive, and I can't recollect such a aggressive rate hike has been ever taken place in last 30-40 years. 75, that means 225 bips rate hike from June, July and September. In 4 months, the Fed has hiked 225. They've gone extremely aggressive, and I think they put, this is the same Fed governor which says that inflation is going to be transitory. There is no need for us to go aggressive rate hike. In fact, if you remember when I came in front of you in month of June and post 15 June rate hike, he did mention in his press conference, all available on the public domain. He said the rate hike going forward may not be as aggressive, but the fact of the life is that it is aggressive. And somewhere there was a fear. In fact, yesterday when I was attending this morning stock conference, there was one Nomura economist was suggesting that there could be 100 bips rate hike. Fortunately, that has not happened. There was a 25% probability that there would be 100 bips rate hike. And the reason was that in Jackson Hole's speech, Jerome Powell has given a very clear-cut indication. Okay, for him, inflation is non-negotiable. For him, 2% is a target he has to achieve come what may. And due to that, if it's going to cause pain, so be it. His way was very loud and clear. And something similar he reiterated that to the US citizens and the US investors. Should we expect 100 bips rate hike because it was not happened this time? Should we expect going forward? I'll come to that also. Due to this 75 3 times 225 bips rate hike, and we saw 50 bips in May and 25 bips in March, and since March, Fed has hiked 300 bips rate hike. Very, very aggressive. And I really don't understand why is that such an urgency to put so much accelerator. I really fumbling to understand why is that so. I think Fed is doing what it is doing. We need to really, and I think time will tell us how wrong the Fed was when it started believing that inflation is going to be transitory. And if you remember, I have come in front of you and loud and clear and I said, Fed is behind the curve. The inflation is not going to be transitory. It has to be more persistent. And I not only said in my webinar, I wrote a blog and I mentioned very unclear terms. And I again believe Fed is going little aggressive, which it should not be. It is going to cause lot of pain unwanted. I think fortunately we have a very sensible RBI governor. I wish I could make very similar statement for the Fed governor. Unfortunately, I am not able to do that. Fed is not willing to see that inflation has to come to 2%. That's what the message is loud and clear. And what is the inflation right now? 8.3. So there is a huge gap between, and if you look at the real interest rate in US right now, it's negative. Why? Because your inflation is at 8.3. Your policy rates are gone up to 3 to 3.25%. So the real rate interest continues to remain in red. And yesterday, while on June when the 75 bps rate hike was done, each and every indices were in a green. But yesterday, Dow, S&P 500 and NASDAQ, they all closed in the red. And why I was saying why this market reacted little post-conferences was this, that there is a clear-cut message which comes out by the median forecast now in US is that interest rate is going to go to 4.4% from 3.25 and maybe 4.6% by 2023, and it will start coming down, and by 2025, that is 3 years down the line, to 2.9%. So we are looking at very long period of time, and I must tell you, no one has a visibility, even including Fed chairman, 6 months down the line. So 3 years is a too long period, and this data will keep fluctuating as and when the new data point comes in. Now, what is happening because of this? There is expectation now that Fed is going to do another 75 bps rate hike on 2nd November, which is almost 45 to 50 days away from today. 75. That will be the fourth 75 rate hike. And that is not done with it. One more 50 bips rate hike on 14 December. So that's what the market in US is discounting. Of course, I do have my own opinion on that. And I'll come to that in the little later part of my presentation. So right now, the experts, many experts in the US do believe that we should expect one more 75 bips rate hike on 2nd November and on 14 December 50 bips rate hike. So 300 bips already increase, another 125 taking it to 4.4. That's what the expectation is. If you remember previously, there was a fear or there was a belief that Fed would start reducing the rate of interest in 2023. But right now, based on yesterday's press conference and based on this ACP, it does give an indication that one should expect another rate hike in the Feb also of 25 bips rate hike. That means the market in US is also now budgeting another 150 basis rate hike over and above 75 bips rate hike that we saw yesterday. Very obviously, when you hike the rate of interest, the casualty has to be GDP. And what is the casualty now, GDP? 0.2% for US this year and 1.2% next year. That's the GDP estimates. As compared to in the month of June, it was expected 1.7%. So one can imagine how quickly the data has deteriorated. Now the basic question that was asked to Jerome Powell in the press conference, that when will he start reducing the rate of interest? I think that's a very critical. So according to me, even if Fed stop reducing the rate of interest, in other words, it maintains the status quo, it would send a very right message to the US investors, US economists and the world at large. But when the question was asked, when will he start reducing it, he said, growth below trend, that's what the economy has to slow down, and that's what the soft landing may not be possible. It looks like right now there could be more hard landing in the US market. He used the word better balance between demand and supply in the labor market. What does he mean is that the unemployment rate has to go up. More people need to get unemployed to bring inflation to 2% and in turn stop hiking the rate of interest. And number 3, he said, is the consistent decline in the inflation, convincing that 2% is a feasible trajectory that inflation can go to. The reason I'm sharing this data with you, that when you now budget in your investment plan, when would the Fed would start reducing rate of interest, you need to understand 3 boxes. Is it ticking or not? And if it is not, there is a high probability that Fed is not going to reduce the rate of interest. And I'll come to my analysis also. How do I expect Fed to, of course, no one can predict for surety or 100% sure, but I do believe that some senses will prevail sooner or later. So, what has happened to the inflation? Let's try to understand the US inflation. If you look at it, 3 months in a row or 2 months in a row, the inflation has come down. It was 9.1% in June, came down to 8.5% in July. In August, it's 8.3%. The core inflation continues to remain at the elevated level, and that's not convincing Fed to either slow down the rate hike or stop with it. But there's one more data point I want everyone to look at it. What was the inflation in January 2021? 1.4%. What is the target? 2%. Am I right? It was below that. What was in Feb 2021? 1.7. The point I wish to convey here, why am I talking about, why am I giving you this data? This data is basically, I want to tell you is that inflation data which has been given by the inflation, the way it has gone up, am I right? the very quickly it can come down also, provided you take a right measures. When you delayed, you did not want to budge that inflation is high. Somewhere in the month of March, you realize what you should have been doing with 75, you did with 25. And then basically, when things consistently remain high, you did not take the appropriate measures to curb it. So before I go and talk about what impact this rate hike would have and how you should play this, I have a very bad habit of going into projection mode. Okay, so these are the rate hike done in 2022, 25 bips on 16th March, 4th May, 15 bips rate hike. And I want everyone to take a snapshot of this. Maybe you can do this one. So when I come in front of you on 2nd November or 3rd November, you at least have a benchmark to understand how good or bad I was in my prediction. On 15 June, 27 July and 21st September, 75. But going forward, I don't expect 75 bips rate hike from the Fed. Why? The consensus is 75 right now. And on 14 December, there is a general feeling that it will be 50 bips rate hike. I believe 25. So in a nutshell, while the overall US market believes that it will be 125 bips rate hike, 75 plus 50, am I right? By end of 2022, I expect only 75 bips rate hike. And I'll give you my reasoning why I think so. And of course, if you don't buy to my argument, that's a different story, but I do have a reason. It's not based on gut feeling, based on some hardcore data. But before I go and discuss that, it's very critical for us to understand what happens to the rupee as and when the Fed hike the rate of interest. Why it's very critical for us to understand? Because when Fed hike the rate of interest, there is a tendency for money to flow out of the emerging market and put in a money which is the safest country in the world, and yet you are getting a higher rate of interest. So then why to take a risk more on an emerging markets or other markets when someone is offering you risk-free returns at the higher rate? So what impact? So normally there is a fear that as and when the rate of interest goes up in the US, there is a tendency to have more pressure on the rupee. And we had seen that pressure being there in 2022, where rupee has depreciated by 7.5% or so versus the dollar. But what I want to look at it also, how rate hike is impacting rupee versus dollar equation. So when on 16th March, when the rate hike was announced, there was no impact till 4th May. The rupee was almost stable. And from 4th May, when the 50 bips rate hike was announced, till 15 June, the rupee was down by 2.5%. Something similar happened when 75 bips rate hike was done on 16 June till 27 July. But the last rate hike did not disturb rupee much. Almost at the same level what it was there on 16th June. And today the rupee did go below 80 rupees and we are down by almost 1%. My sense is that the reason I'm sharing this data with you people, I don't expect rupee to see much pressure from this level. So for some reason, if you are getting a little jittery about a US Fed has hiked the rate of interest, we should all be concerned about an FI may go away because of it doesn't suit them, am I right? If the rupee depreciates against the dollar, the returns in dollar terms doesn't goes up. In fact, it goes down. And should that be the cause of concern? The answer is no. Now let's try to understand that we understood the impact of Fed rate hike on the rupee. But what happened to the to the Indian market? Did Indian market came down substantially or is it moved up? 75 bips rate hike. So since then, we are basically moving up. We are not going down. In fact, that was the lowest point that we saw market correcting very significantly in next couple of days. But then market moved up. That happened on 15 June. It happened post 27 July, which was another 70 bips rate hike. And I can tell you, when I present in terms of 3rd November, similar graph would be there, where the market would have gone up, not gone down. You know, if you remember, I have been saying time and again, And now what I was been saying for last couple of months, others have started talking about the similar language. There is a decoupling of Indian market and the US market. So yesterday US market went down substantially, right, 1.7 and 1.8%. Did Indian market correct it so much? The answer is no. In fact, today more company advanced and did decline. If you look at BSE 500, the advance decline ratio, 282 companies advance. Only 218 company decline. What does it indicate? Did market? तो ये मंदी है ना दिमाग में है. We are all fearful in our mind, and unfortunately some experts, they are misguiding the gullible investors. I must tell you that. They don't understand the impact, and they basically create fear, and that fear is forcing many to do things which you are not supposed to do that. So look at what happened to the Sensex and Nifty, down by 0.5 and 0.6%. BSE 500, which consists of large, mid and small cap, was marginally down by 0.2%. But mid and small cap close in the green. And again I repeat, so I talk with data, I don't talk with gut feeling. The data clearly says, whether this graph or whether this price movement, it clearly says that there is a decoupling of Indian equity market with the US market. Yes, there will be impact. I'm not disputing that. It's a very wishful thinking. If the US is going to slow down, there will not be an impact on Indian market. There will be impact, but impact would be short and not enduring. It will not be painful. At the same time, I again say, crisis is an opportunity for India. What's happening in China, what's happening in Europe will make Indian economy strong. Why? Because more outsourcing, more plants coming, more manufacturing coming, and that will make India a stronger economy. And if this, and look at the wisdom of the market. Forget about my wisdom. My wisdom is has no meaning. But what does the overall wisdom of the market says? There was no reason 282 company has to advance today with the 75th rate hike. Am I right? And despite people know that there will be one more 75 bips rate hike in November and 50 bips rate hike in the month of December. And yet more company advance than the decline. So completely market is telling you, do not ignore market wisdom. Is telling you market is going to do extremely well, whether you like it or not. आपको मंदी करना है कर लो, आपकी choice आपकी है, पैसा नहीं बनेगा आपका. So we do believe that Indian market will have a very limited impact due to the Fed rate hike. Do not panic. Do not do something which you have to repent little later. I distinctly recollect many investors, and I have a live examples of a Mojo Infinity customers started taking a cash call on the market, following only sell advice, not buy advice, in the month of June and July, and they paid very heavy price in terms of the performance. We did not expect, we did not see any negative impact in the month of June and July hike, and we don't believe it will happen even in the month of September rate hike. We do believe, and this is my personal opinion, see, the impact, the percolation of that rate hike, it does take time. It doesn't happen immediately, which every central bank will admit that. And I think Fed need to understand somewhere, and they will realize sooner or later. That's what that's one of the reasons I do believe they will not do another 75 bips rate hike. They will do only 50 bips rate hike. Why I'm saying so? Because that lag effect will start playing out very severely. And due to that, the 225 bips rate hike that has already been done in since June will start slowly transmitting to the economy, and we would see that's impacting the inflation and making inflation a little softer. So somewhere that lag effect makes me convinced that rate hike going forward will be very, very low as compared to what has been predicted or it is believed by the US market, the lag effect. And it's a very important parameter to understand lag effect. We do believe that the way Fed has gone aggressive in terms of rate hike, they would be equally aggressive in terms of reducing the rate of interest. And that's going to happen in next 1 year. Today, September 2022, I'm making prediction that Fed would be aggressive in terms of cutting by September 2023. And due to that, the sentiment which is getting impacted right now will get further improved. RBI is not going to remain silent. It has to protect rupee, and hence do expect 50 bips rate hike by RBI next week. And of course, I'll do a webinar on RBI rate hike also, and we'll discuss how RBI is assessing the overall equity. We continue to believe, despite 75 bips rate hike and another 125, that is what market is budgeting for, we continue to believe Indian equity market will have a better sentiments by Diwali 2022. Do not panic, do not listen. See, human has a tendency to, which is psychological. There is nothing wrong with you, nothing wrong. This is human psychology. If you are bearish on the market, you will read only those news which reinforces your view. And if you are bullish on the market, it will reinforces only, you will read only those views which are positive. And that's the beauty about the market, Don't get carried away by the negative, which is impacting your sentiment. Remain calm, composed. Indian equity market, I again repeat, in a structural bull run. And the structural bull run doesn't get impacted by few rate hikes here and there by the Fed. I again repeat, India has completely decoupled as far as stock market is concerned from the US market. I do believe US will have to endure more pain, but not India's equity investors. We need to look forward to a lot of gain. India has been outperforming market in 2022, rightly so, despite FI have been heavy sellers in this Indian market. And a lot of credit should go to retail investors who acted in a very matured manner and keep pumping money at every decline to create more wealth. I must tell you, I must congratulate many of our Mojo Infinity customers. They also use every dip in the market to add more money to create more alpha on the portfolio. With this, just a gentle reminder that we do have a lowest rates only for our webinar attendees. And what is the rate? Only 19,999 for 2 years, which works out to 10,000 rupees per annum and less than 30 rupees per day. And you can extend as many times you wish to do that, our subscription for 19,999 for 2 years. With this, I'll be more than happy to, Jason, let's open the floor for question answer. I'll be more than happy to first take questions which are relating to the Fed, and if time permits, then we can go to the other topics.
Okay, I'll start off with this first question by Noor. With the rising interest rate, will it be appropriate to invest in banking and NBFC stocks? I want to know the prospects of IndusInd and Bajaj Finance.
So both IndusInd Bank and Bajaj Finance are buy in our system, but they are not a Mojo stock. My sense is that as and when the rate of interest goes up, it does creates demand slowdown. Loan growth book starts because people will delay or defer their capex and opex. Number one. Number two, when the rate of interest goes up, people tendency not able to repay the loan goes up. Why? Because your EMI goes up, and that due to that your budget goes for a haywire. So I do believe that they may underperform. That's what my sense is, Noor. Of course, I have been proved wrong in last 1 or 1.5 months or 2 months, but I continue to believe that banks should underperform. Second thing, there is a liquidity which we must have all read about in the system, which is going to push. If you wish to keep growing, you need to have savings in your the deposits with you. Am I right? And if you wish to do that, you need to end up being higher, which could impact your NIM. So that's another danger, Noor, I believe, for the banking and NBFC stocks.
Okay, moving to this next question by Mr. Rajiv, he says, Sunil Bhai, RBI will also increase the interest rates following Fed rate hike and could cause rupee depreciation. Will there be any impact on the 10-year bond yields as well in India?
So, if you speak to some of the dealers in the fixed income side, they do believe that it's already priced in. There is a feeling that 50 bips rate hike would come from RBI, and that's what I mentioned in my presentation also. And I did mention that I don't expect rupee to depreciate much. So don't expect there is a run on the rupee. And your question, will the 10-year bond yield, will there be an impact? Definitely there will be impact, but I think not so much because it's already priced in. I think markets somewhere have discounted that it's already going to come. So there are expectations, so the prediction anywhere between 32 or 35 bips to 50 bips rate hike. But I believe 50 bips rate hike is going to come. So don't expect too much volatility in the bond market because of this.
It's a question by Mr. Satish. Many times people have made statements like India is not affected by the US, India is decoupled. You said that also in one of the webinars. Whereas in 2008, the Indian market fell 63% while the US market fell 55% from peak. It took 5.5 years for the Indian market to reach the Jan 2008 level. How do we need to look at this? The reason we are still linked to global macros.
So very good question, Satish, and I think very similar question was asked by one of our Mojo Infinity customers to me today morning. It's a very fair assumption to make and fair analysis to make. Now let's rewind back. What happened in 2008? And let's look at the similarity between 2008 and 2022. In 2008, we saw a very structural rally in the Indian equity market from 2002 to 2008. And the indices went up substantially. So there was a lot of froth that was there in the Indian equity market. Did we see very similar kind of a froth at this point of time in 2022? The answer is no. On the contrary, market has been struggling in 2022. What is the total YTD gain? Maybe 1 or 2%. So there is nothing which is a froth that is there that has to go off, which was there in 2008. That was number one. Number two, in 2008, we were completely dependent on the mercy of FIIs. Are we at the mercy of FIIs at this point of time? The answer is no, because we saw what happened. Despite they were selling in the market left, right and center, unprecedented sell. Did we underperform? We outperformed. We outperformed the US market. We did not underperform the US market, even in dollar terms. Why? Because in 2008, we did not have retail investors. In 2022, we do have retail investors. Number three, in 2008, India Inc. was highly leveraged. Are we highly leveraged? The answer is no. And if you look at it, the cost structure of India Inc., they have substantially improved the cost structure. While in 2003 to 2008, there was a lot of cost structure which went haywire for India Inc. And why did the cost structure improve? Because we had seen disruption one after another. First, it was started with demon, then GST, which was not the best way one should have expected to it. Then we saw coronavirus, and then we saw this supply chain issue because of corona, and then there is a war between Russia and Ukraine. So there is no froth, and hence to make comparison to 2008 and 2022, I think is unfair to make. Number one. Number two, in 2008, India's inflation was much higher there as compared to the US inflation. Here the situation is reverse. India's inflation is much lower as compared to the US inflation. So hence to make comparison 2002 and if you are saying that market is going to crash by 63%, I doubt, sir, that's going to happen. 63%, matlab what we are saying is market going down to 20,000 level from 60,000. This is a mota. I don't think that is a possibility. That's probably going to happen. So Satish, your question is right. I'm afraid but that hypothesis is not going to play out the way you are trying to suggest.
Okay, moving to this question by Mr. Rahul. Hi Sunil, he has two questions. On what basis and factors are you expecting Fed to hike rates by 50 basis points in November, even after persistent high inflation? You had expected 50 basis points hike this time also, but it was 75 basis points. Also, I'm a Mojo professional user, wanted to know if I have a corpus to invest, how to do it now? Should I divide it equally in all Mojo stocks?
So Rahul, you're right, absolutely right. And if you remember when I did prediction, I did mention that 50 bips. I was surprised with 75 bips rate hike. And that's one of the reasons I do believe that the Fed has gone little aggressive in terms of, and the reason I believe it will do only 50 base purely because there is a lag effect which I was talking about, which the transmission happens little slow to the economy. And that will, so what has happened 75, 75, 70, 225 is too harder. It's like a too bigger a dose that you give it to the this one, and you don't need one more higher dose because it could basically overreact. So that's the reason I believe that. I do believe that the inflation should come down a little bit. Of course, I'm not expecting 2% to come down to, but the trajectory in US should be little. Inflation should, because a lot of supply side constraints are easing. A lot of commodity prices have started coming down, and that should give some relief on the what we call the inflation data points. So that's the reason I believe that it should be 50 bips. Of course, it is a prerogative of a Fed chairman what rate he wants to do. I'm making my own assumption, and my assumption could be wrong, and there is no obligation on the part of Fed chairman to listen to my suggestion. Your second question is that you have a fund to invest. I would request Rahul that please invest either in model portfolio or Mojo Infinity portfolio. That's the best way you should do that. Why? Because sometimes some Mojo stocks may do well, some may not do well. But when you take a portfolio approach, that portfolio approach will always be the winner. And hence, risk versus return, portfolio is a better approach as compared to the individual stock picking. But please go ahead. I maintain very clearly, loud and clear. I have been maintaining that by Diwali time, the sentiments would be much more jubilant. And I do believe that would be the case. Now, what could be the reason for that? It could be that inflation start cooling off in US much faster than everyone expects. Or there is a ceasefire between the Russia and the Ukraine, and so on and so forth. See, today the market shown a lot of character, a lot of strength, Indian market. Why? Because Russia yesterday announced that they are going to add more manpower to the military, and logically there was a fear that there could be a nuclear strike and so on and so forth. But market did not react so negatively. Am I right? And 0.5, 0.6% decline could have happened in another day also, without the news like Fed hiking 75 bips rate hike or Russia doing that, which clearly suggests that the undercurrent in the market has been extremely strong, and we should not unnecessarily take a pessimistic view of the Indian equity market.
Okay, Mr. Sunil, the ending of your answer was actually the beginning of my next question by George. He's asked any implication with respect to this Russia's development of calling reserve persons. May it result in another war?
So George, I also getting a sense that somewhere Russia has to understand what's happening on the war front. And our Prime Minister did make a statement to and inform Russian that this is not a time for war. And I think a lot of other global leaders seconded what Mr. Modi suggested to Mr. Putin. So yes, they are calling reserve. Does it going to create more panic, maybe for a day or so? But I'm getting a sense, and just based on the reading I'm getting it, that somewhere there would be some compromise formula that may get worked out to ensure that, things doesn't get escalate from what it is right now. And hence, and see, today the whole world has only one problem to look at it. That's a Russia and Ukraine war. For some reason, if there is some positive news, it will give a lot of fillip to the sentiment, and which in turn would reflect in the stock indices. So if war escalate, yes, there will be the impact, no doubt about it. The only assumption mine is that the war may not escalate as much as what everyone is fearing because of calling reserve army into the to the war. So I don't think that's going to create more kind of a situation is going to get worse, and that's what my underlying assumption that I am making.
Okay, this question by Mr. Sunil Bhai, in addition to Fed hikes, Indian market is highly overvalued amongst emerging markets. Will that not lead to sustained corrections in the next few months?
No, so if you remember, I did make a presentation where I said that yes, Indian market is richly valued as compared to the other emerging markets. My question is why we should not command the rich valuation? Why Apple phone should not command a more premium as compared to any of the Android phone? Because it has a feature, that's why Apple is able to command that kind of a premium. The same way, see, we are all looking at India from a 10 years perspective, and then we are saying we are India's expensive market. But the 10 years yardstick itself is wrong. Why it's wrong? Because India is not the same India which was in 2012 and 2022, and then you compare 10 साल का तो price earnings से ज़्यादा है. It doesn't make sense to invest now. This is new India. This is China plus one policy. This is India which is going to be the fastest growing economy in the world with the lower inflation. And hence, if India does not command rich valuation, which country will command a rich valuation? And assume India is commanding rich valuation, then logically, FIs are more mature, am I right? They look at the valuation. Why are they pumping money in the Indian equity market? On the contrary, they should be selling in the Indian equity market. If that is so, why emerging market is down by 22% and Indian market is in positive in 2022? If the valuations are a concern, the more money should have gone to the emerging markets and then the indices should have been better, am I right? I have a very contradictory view and I say, why should we not command premium? We should rightfully command the premium, and we will command that premium come what may. Because India has a story, and when you start discounting 3 years down the line numbers, India looks very, very cheap. Because the underlying growth in the economy is so strong, I don't believe, sir, that India is a highly overvalued. I think you have used the word highly overvalued. I don't agree to that statement.
Okay, we've got this question by a couple of investors. This one by Mr. Mohit. How increase in unemployment could reduce inflation?
Very simple, sir. When there's an unemployment, people ability to buy goes down. And when people ability to buy goes down, more supply, less demand. And it's a law of economics which push down the prices. Today the inflation is high because there is a more demand, less supply that pushes the price. Higher unemployment reduces your ability to spend money and which reduces the demand. I hope I made it very clear and very simple to understand.
Okay, this next question, Mr. M. Putamkar. Because of the rate hike by Fed, do you see more inflow of funds from FIs and other foreign investors now?
So logically, if you ask me, it should be the reverse of that, isn't it? Because when Fed hiked the rate of interest, the money should move out from emerging markets to the developed market. That's what normally happens. But we have not seen that happening. So I do continue to believe that. So don't link with the Fed rate hike. I continue to believe why India will attract fund because of its growth story. So, you look at the capex being announced by Indian corporates, whether it's an Ambani, whether it's an Adani, whether it's a Kumar Mangalam Birla, whether it's a JSW group, whether it's a Tata, everyone has been talking about capex. And capex is not in the old economy. Capex in the new, whether it's this PV solar cell, hydrogen, electrical vehicles, and so on and so forth. So I think this is the first time India is talking about, Indian companies are talking about investing in the technology of the future and willing to do the capex. So I think that's a very good thing to have. So I do believe, don't link with Fed rate hike link FI coming to India more on the India's growth story than anything else.
Okay, just one question by the investor. Will it cause interest rates to go up in India too? In that case, our market should correct significantly. Now, currently, Nifty P is around 21. Interest hike in India may pull down the market to the level of Nifty P of 15. This is my fear. Please clarify, Mr. Sunilji.
So your fear is not out of the place, sir. Will it come down to 15p? It's a matter of debate. So I do believe that RBI will do 50 bips rate hike by end of this month. But I believe that would be the last rate hike from RBI. We should not expect more rate hikes from RBI, and most probably they would also start cutting the rate of interest because they don't want to disturb the growth in the economy. I was mentioning Nifty 50 21. It's not richly valued. I do believe it's highly attractive valuations purely because of underlying growth would be very, very high. And hence, I don't expect that Nifty to go to 15 level because that would be almost 40-45% kind of a decline that we are talking about in the indices, which I don't think is going to happen. So, sir, your fear, I believe, is little stretch at this point of time. I don't expect this to happen, sir.
Okay, we are getting a couple of questions on the banking sector. This question from Mr. Chaitanya. As per RBI reports, banks will have lowest NPA in financial year 23 in last 10 years. Will this not help bank stocks go up?
So I perfectly right, sir. You have read it perfectly right in RBI report. My only sense is that with limited knowledge that I have about the banking is that when the rate of interest goes up, investors or borrowers' ability to repay the loan goes down, and which result into an NPA. So my sense is that yes. So nothing happens immediately, sir. It is not that today you hike the rate of interest and NPA will start reflecting from next week or next month or next quarter. It does have a lag effect, but it will happen, and somewhere market is going to look at this factor. Unfortunately, sometimes little you are ahead of the curve and you are able to predict little in advance, but eventually everyone, like, in January 2022, we said that Nifty can touch to 15,000 to 15,500. And when market went up in the month of March and April, you people said, ये तो prediction कभी सही नहीं होने वाला इनका. Am I right? But it didn't happen. So, fortunately, we are able to see what others are not able to see because of our strong data analysis. And based on that, we are saying that NPA level will go up. It's not going to go up immediately. But somewhere in the month of December, November, December, market will discuss about higher NPA going forward, and that would create some amount of pressure on the banking stocks.
Okay, Mr. Shyam has made this particular statement. He says, in short, you seem to believe that even if there is global recession, India will grow maybe at a slower rate.
Yes, you are absolutely correct. You understood correctly. India will, and when we say slow, we are not expecting India to grow at 5%. Let me be very frank with you. India will consistently grow in excess of 5% in real terms. So you are right. Yes, there could be a slowdown, but not so much slowdown that we need to struggle for the growth.
Okay, this question by Mr. Venkat Giri. He says, when do you think the base effect will start playing up and inflation will start trending down in the US? Also, what will be the impact on export-dependent sectors due to slowdown in US, Europe, and China? And which companies would be affected the most?
So there is a lag effect that happens, and so the base effect should start playing out in US logically in next couple of months, not beyond that. And that's one of the reasons I do believe that only 50 bips rate hike and not much from the Fed by November. So that's my personal assumption. You are right. There are many companies who are dependent on the export market to US or Europe. I think they would have some kind of a slowdown impact. What impact, what quantum, what strategy they are going to do, we need to wait and watch. But at the same time, since there is a power cost has gone up substantially in the Europe, it also opens up an opportunity for someone to supply because it may not be feasible for the local player to produce and remain competitive, isn't it? And hence some exports can happen from India to meet those demands which has gone out of the production. So we need to wait and watch when it would vary from company to company, because what strategy companies are adopting to counter that, we need to wait and watch. So my sense is that US definitely textile and others would definitely have some impact. Despite cotton prices coming down, I think this products sale would definitely take an impact in the countries like US. Some of the Europe, what kind of slowdown they have, what kind of rate hike they do, what kind of, because chemical could be one product that could find place in Europe. Some of the engineering goods, they could find some demand because of the local players not able to meet. If India relaxes some norms in terms of export of steel and so on and so forth, it could also open up an opportunity for Indian steel companies and so on and so forth. So I think we need to wait and watch. We need to get more clarity right now. But definitely there will be positive impact and there will be negative impact. And depending upon how each company planning to seize that opportunity, it's going to vary from a company to company. So don't have a sector approach, look at the company approach, because I do believe some companies will not be able to reap benefits of that because they don't have that understanding or creating a business sense to export to Europe and get a benefit out of that.
Okay, this question by Mr. Jacob. India's real rate is also slightly negative, though not huge like US. So when Fed increases rates more and India doesn't, rupee would weaken further. Will this not impact Indian market also negatively? To what extent? Do you have any views on this?
So your observation is again right, Jacob, that NLB has gone on the record saying that they want to have a real interest rate at least 100 bips or 150 bips. Okay, so they've gone on the record. So we do expect 50 bips rate hike, but we do expect inflation to start inching down, and that would make India's real interest rate positive. And if India's real interest rate is positive and in US it's negative, we all know what happens then. So I don't expect much of an impact on the currency.
This question by Mr. Anand. What is the downward protection logic for MarketsMojo's model portfolios? Many of the July and August portfolios are deeply still in red. Can you please give a thought process on protection in the downward cycles?
So, sir, we do have a fall from high as a concept, Anand, in our model portfolio in Mojo Infinity. If some companies fall by a certain percentage vis-a-vis the benchmark, we do get out of those companies. So, you don't suffer too much. What is the downside protection? See, remember, market by nature is volatile. Okay. Now the point is that what should we expect? And there could be a black swan event that happened in March 2020, and we have seen our model portfolio going down by as high as 50%, 50. But then they bounce back also. So I think what you need to look at it, the downward protection comes and downward cycle comes into mind only when your investment horizon is little limited. The moment you expand your time horizon, then it doesn't matter. Why? Because market would have come down and would have moved up also. I'll give you a classical example, which yesterday Prasanth Jain was mentioning in his morning stock conference. He said, assume that Indian equity market was the costliest ever was in 1992. We were commanding in excess of 40 PE. And he said, you bought at the costliest price, the Sensex, and you remain invested till 2022. And based on his calculation, he said, you add dividend and everything, the Sensex would have been in the region of near about 1 lakh. The return would have been near about, the value would have been near about 1 lakh. So from 4,000 to 1 lakh, despite you bought at this one. So, and market did go down, am I right? More than 50% in the interim. But market absorbed that, it bounced back and it made new highs every time. So your thought of downward pressure should only come to your mind if you are coming to the market for 3 months, 6 months and 1 year. The moment you expand your time horizon, there is no reason for you to worry too much. Coming back to your question about July in 2024 in the red, maybe yes, you may have done some more investment in that portfolio and it may be red. But as I've been mentioning time and again, in October 2022, by October 2022, the same portfolio that we are talking about in red would be in the green. And remember, Indian market by nature is non-linear returns. So what happened in the past is not going to happen in the future. So if it has gone down in the past, doesn't mean that it's going to keep going down. And as and when it turn around very, very fast.
Okay, you got this question by Mr. Chetan. Can I get a 2-month trial for MarketsMojo?
Sorry, 2 months trial.
Yeah.
सर मैं आपको दे भी दूंगा, आप क्या कर लोगे? चलो, will you form an opinion? Assume that it start doing very well. Your experience with it, so you'll subscribe. But then what happens? Are you remaining invested for 2 months only? And other situation, it doesn't do well, Chetan. You'll come to conclusion the product bekar hai. बराबर ना? So that's not the yardstick, na sir. 2 months in an equity market, I think your fundas are not clear about equity. Equity is all about long term. Equity is all about wealth creation. And wealth creation doesn't happen in 2 months, sir. I'm sorry, we don't have any 2-month trial. But even if I give you, you should come and say, I don't want it. Why? Because we want to create a very serious long-term wealth. And 2 महीने में कुछ नहीं होता है. Long-term wealth 2 महीने में नहीं होता है, सर. आप राकेश झुंझुनवाला का देख लीजिए, वॉरेन बुफे का देख लीजिए, सबसे बड़े बड़े इन्वेस्टर्स का देख लीजिए. 2 months is not a period only to evaluate also. So you should come and tell us. In fact, if we give you should say, why are you giving us? Because that's not a good enough to. Have you ever evaluated a fund manager for 2 months? कि तुमने पैसा डाला म्यूचुअल फंड स्कीम में, 2 महीना स्कीम नहीं चला, आपने पैसा निकाल दिया क्या? You give time, am I right? So your evaluation criteria itself is wrong, sir. And hence I'm a little surprised, Chetan, either you are new to the equity market or you don't understand the nuances of the stock market and hence asking for 2 months trial.
Okay, I'll move to this question by Mr. DP Monti. He's asked a couple of questions. He says, suggest that we could pick more questions from Infinity customers making loss more than 5%. He says that 12 stocks have been booked loss and no profit booking call received. And yeah, moving on to the next part is that there's been some wrong selection.
Let's take one question at a time. Suggest that more questions should be picked up from Mojo Infinity customer making loss more than 5%. Sir, we need to be fair to all our Mojo Infinity customers, am I right, sir? And we can't basically differentiate between loss and the profit. See, at any given point of time, there are more investors attending our webinar, and it's our job and duty to give reply to each and every one. So sometimes it may so happen, sir, that you may ask us a question and we may not be able to pick up. Why? Because someone else has not been also answered. And we need to be fair to them also. And hence, your suggestion is that, someone is making loss more than 5%. So what is a crime someone else has done when he asks a question and we are not able to pick up? And that question may not be on the performance, but the question may be more based on he wants to or she wants to understand some view on the sector or some macroeconomic views. And if you don't respond to them, they will feel bad. So I think to differentiate someone purely based on loss and profit would not be possible. Point number 1. Number 2, Jason would not have whose customer is making loss and whose customer is making profit. Am I right? That data is not available to him. And if that data is not available to him, how is he going to select? And many times people put name in such a fashion that we even don't know whether this investor is a Mojo Infinity customer or not. Because we identify the customer with email ID. But the email ID is not available. So sir, I am afraid, sir, your suggestion I will not be able to accept it. So that's the suggestion number 1. 12 stocks loss booking call received and no profit booking call received. Sir, we do have a profit booking as a criteria concept being introduced. In case if it is not triggered in your portfolio right now, that profit booking, don't worry, sir, it will get triggered and we will tell you. It happens automatically. You don't have to write to us. You don't have to worry about it. It will happen, sir. It's my promise to you. It will happen. Question number 3, 80% stock have exited. Should have 30% stock exited should average 10 to 60% appreciation. I'm not able to understand that question. Jason, if you can help me understand this, decipher this.
No, I'm actually not able to interpret it as well. If you could send it again, sir, I'm not sure.
And wrong selection and wrong result loss varying from 15 to... Sir, my request to you, please have patience. Bohanti sir, I keep saying again, time and again on this platform, patience, discipline, and faith. And I'm telling you with a lot of confidence, sir, you will make a lot of money from the equity market on Mojo Infinity. Unfortunately, we come to conclusion based on 2 months, 3 months, and 6 months performance, and then we decide good or bad, which I think that's not fair. So I can tell you, Mohanty sir, very proudly and very confidently that you will make very good money in Infinity, provided you follow our advice and disciplined manner. और 3-5 साल का टाइम दे दीजिए सर, आपका पैसा बनेगा. And if you remember, we have said time and again in Infinity, if your time horizon is 3 months, 6 months, and 1 year, please don't come to Mojo Infinity, because that product is not fit for you, sir. We always say, and forget about Mojo Infinity, even for equity as an assets class, we say, if you need any funds, in 3 years or so, don't come to equity market, because equity market by nature is non-linear returns. And you will get frustrated if you work, because you will be forced to get out of the market at the wrong time. Why? Because you need liquidity at that point of time. So please bring in only those money to the equity which you don't need for next 3 to 5 years. So that's what my advice to you, sir.
Okay, Mr. Sunil, that's with the Q&A session for today.
So thanks a lot. Again, just to summarize, do not panic, remain calm and composed. Market should do very well. And why I'm saying so? Because India has an inherent strength, and don't compare what happened to 2008 and then try to correlate with 2022. I think that would not be the fair to do that. US market ko jo hona hai wo hone do. Indian equity market should do extremely well. I again repeat, the mood in the market by Diwali would be extremely jubilant. We are not very far from Diwali time, and hence have patience, have faith, and follow the advice and discipline. If you're really sincere about creating wealth, and I said that structural bull run, we do have a subscription offer of 19,999 for 2 years. You should not miss it and avail immediately. With this, thanks a lot, Jason, for hosting this webinar. Over to you.
Thanks a lot, Mr. Sunil, and thanks a lot, everyone, for attending today's event. We do have an event tomorrow for our Mojo Infinity customers, and we'll be shortly informing all about the same. Looking forward to seeing you all come for the events as well. Goodbye and have a great evening. Thank you so much.